I don't think they're going to be able to get to positive real rates, meaning rates that are higher than inflation levels. They're certainly trying to uptick them, but of course they're doing it rather slowly. I mean, we're sitting here with, as you said, like 8% inflation, and they're like, okay, 50 basis points here, 50 basis points here, which is funny because that's actually the fastest they've done it in 20 years. In the U.S., we haven't had 50 basis point hikes for like 20 years, but it's also woefully insufficient. Well, so essentially, we're having an inflationary crisis, and it's hitting developed markets for the first time in decades. I mean, developing countries go through this regularly, at least many of them do. And now it's hitting developed countries across the board, some harder than others, especially Europe, less so Japan, but really across the board. And because that's mainly because commodities are a global market, and that's a big driver of what's causing this as well as supply chains. And whereas last year we were in this pure inflationary phase, now we're kind of in the central bank counterattack phase where, they kept saying it was transitory. They kept saying, don't worry about it. This will be, there's base effects and things like that. And some of the base effects were real, but they were sugarcoating the type of inflation that we were actually getting and probably about to get. And because they weren't acknowledging how much new currency supply was created in a short period of time compared to real world constraints around commodities and logistics and things like that. And so we both have limitations on the real world side while also having a lot of currency having been created. And so now we're seeing the inflation roll through the system. And it's particularly getting bad in Europe, but it's bad, throughout the world at this point. And so now central banks have their credibility threatened, where they said it was transitory. It's far higher and less transitory than they kind of sold the idea would be. And so now they're in the phase where they're trying to tighten policy, but the whole point is that unlike say the 70s, there's so much debt in the system that trying to tighten policy is kind of this temporary thing where they want to act like they can stabilize this whole thing. We can get back to positive real rates. We can totally normalize this. But the problem is that the only way for the central bank to push back on inflation is to reduce demand. They can't print oil. They can't print copper. They can't print chips. They can't, just magically create new pipelines and get all that stuff where it needs to be. And so they say, okay, there's a supply side constraint. We have high inflation. If we reduce demand, we can take the edge off prices. But what is a reduction in demand? It's a recession. There's two main problems. One is we've underinvested in energy in multiple ways for several years. And so there's just not enough energy and it doesn't get easily to where it needs to go. So that's number one. And that's very different than the past decade where we spent a large portion of the time with an energy oversupply because we brought in a lot of new types of oil to market, particularly shale. And we also had a slowdown in emerging markets. So demand was less than anticipated and supply was more than anticipated. So we had this glut of oil for a period of time. And that really destabilized prices, brought them low. That's good for some industries, obviously bad for the producers. But now, due to the combination of nobody wanting to invest in that because the prices were so low and because of ESG concerns and things like that, there's been underinvestment. And we've kind of drawn forward a lot of the benefits we got from shale, right? So that rapid increase in shale can't just keep continuing the way it was. So now we're in this phase where we don't really have enough energy. And it also doesn't get to where it needs to be. And so that's just a constraint. And that takes time to work through. That the market forces have to work through that and find new energy to bring the market, different types of energy. And of course, the other one is the whole supply chain. So for the past 10, 20, 25, 30 years, we've had this period of persistent globalization where we're finding these big pockets of labor throughout the world that were previously relatively unused in the global market sense and optimizing that, or geographic arbitrage, where you say, okay, so instead of having this expensive factory in, Detroit, we'll go ahead and move it to China, right? And so you arbitrage that labor cost difference, and we've had that pressure for really for 25 years now, especially the Chinese part of it. And in some ways it's been longer than that, but really that past 20, 25 year period has been very aggressive in terms of how much globalization's happened, and that's been a very disinflationary force. And so the concern is that as that kind of levels out, and then even if it just doesn't deglobalize, if it just stops continuing to globalize, that's going to probably be inflationary. And then as it if it actually pulls back and we actually pull some supply chains back to the developed world, that's even more inflationary. My expectation is that if you look back at the 40s and the 70s, you had very high inflation, but it wasn't a straight line. You had periods of pushback.
Okay.
And so I think right now we're kind of in a period of pushback. And it's challenging to say how successful that's going to be, because partially depends on understanding the breaking point when people riot, understanding, is it going to be any sort of de-escalation in this war or no? So those are variables that can influence it. So in general, I am positioned towards an inflationary outcome without trying to predict exactly what level inflation is going to be, especially because, as you pointed out, there's real numbers. There's different pockets of inflation. So I think that looking back at the end of this decade, energy prices are going to be much higher in dollar, euro, pound, yen terms than they are right now. But I think it's not going to be a straight line. When people buy high and sell low, I try to just tweak it a little bit and do the opposite. But I'm not like I'm not actively trading the market too aggressively. Just kind of a small dial that I kind of lean in when things get a little cheaper, and I kind of back off a little bit when things get a little bit euphoric. I think a lot of the market is still thinking this is transitory, and they're also concerned about the what percentage of the profits they'll be able to keep and things like that. And so we're not seeing this massive ramp up in CapEx. We are seeing an interest in CapEx. And then ironically, some of the supply chain things can feed into that. I mean, some of the materials they need to do energy CapEx are actually held up from logistics problems, right? So it kind of all ties into each other. But I think that this is a multi-year process to realign supply chains to some extent, as well as bring more and more types of energy to market. I think this is so historically, these commodity cycles are these 5 to 10 year cycles. I mean, they take quite a bit of time and capital to ramp up. And I don't really see this one being any different. And I'm kind of monitoring as we're seeing high energy prices. I'm seeing is tons of more CapEx flooding into the market? Not really. We're seeing an uptick, but we're in no way of measuring. Are we seeing like a massive glut of oil coming anytime soon? I don't think they're going to be able to get to positive real rates, meaning rates that are higher than inflation levels. They're certainly trying to uptick them, but of course they're doing it rather slowly. I mean, we're sitting here with, as you said, like 8% inflation, and they're like, okay, 50 basis points here, 50 basis points here, which is funny because that's actually the fastest they've done it in 20 years. In the U.S., we haven't had 50 basis point hikes for like 20 years, but it's also woefully insufficient. Regardless of what they do with rates, that's not what solves this. What solves this is bringing more energy abundance and commodity abundance to markets. And in the meantime, I think they're going to try to protect their currencies until you start to get outright recession, or you get credit markets freeze, or you get sovereign bond markets get illiquid and messy, right? So in the United States, that could mean that, whenever you see the dollar gets too strong, foreign sector doesn't buy a lot of treasuries, banks already are stuffed full of treasuries. Who's the marginal buyer of treasuries? So you get less liquidity in the market. It gets messier.